If your goal is to build passive income from investing, these are some of the most popular ETFs people use to generate cash flow from their portfolios. Hi, I'm Kelsey. I studied finance at Georgetown and built a seven-figure portfolio, all from investing in the stock market. One of the biggest misconceptions about investing is that you only make money when you sell, but some ETFs are specifically designed to generate income by paying investors dividends every month or every quarter. None of this is financial advice. This is just a breakdown of some of the most popular income-focused ETFs and how they work. First is SCHD, which stands for Schwab's US Dividend Equity ETF. This ETF focuses on large established companies with a strong cash flow and long history of paying dividends. Some of its holdings include Coca-Cola, Home Depot, Cisco, and Pepsi. SCHD is popular because it balances dividend income and long-term growth. Right now, the dividend yields around 3 to 4%, which means that investing $10,000 could generate roughly $300 to $400 per year in dividends depending on market conditions. It also has a very low expense ratio of 0.06%. A lot of investors use this as a core dividend ETF because it's relatively diversified and less aggressive than some high-yield funds. Second is JEPI, which is JP Morgan's Equity Premium Income ETF. This is designed specifically to generate monthly income using a covered call strategy. Basically, the fund owns stocks and then sells options contracts to generate extra cash flow. Because of that strategy, JEPI usually pays a much higher yield than something like SCHD. Its yield has recently been around 7 to 9% annually. But the trade-off here is that the covered call strategy sometimes underperforms during strong bull markets because the upside can get capped. JEPI is usually more about income stability than maximizing growth. Third is JEPQ, which is similar to JEPI but focuses more heavily on technology and the NASDAQ-style growth companies. Its holdings include companies like Microsoft, Apple, Nvidia, and Amazon. JEPQ also uses a covered call strategy to generate monthly income, which is why the yield is often around 9 to 11%. This ETF tends to be more volatile because it has more exposure to tech stocks, but a lot of investors like it because it combines growth and passive income. And last is QQI. This ETF is also focused on using an options strategy to generate monthly cash flow, but it's specifically tied to the NASDAQ 100. So it has heavy exposure to large technology companies and AI-related stocks. Recently, its yield has been around 14%, which is extremely high compared to the traditional dividend ETFs. That higher yield also comes with higher risk and more volatility, so this is definitely not the same type of investment as something like SCHD. For example, a 14% yield would mean that investing $20,000 could generate $233 per month before taxes, although yields can change over time. For me personally, I think income ETFs are interesting because they can help create cash flow without having to sell your investments. But the higher yield usually means the higher risk, so it's important to understand how the ETF actually generates income before investing in it. At the end of the day, passive income investing isn't really about chasing the highest yield. It's about building a portfolio that gives you enough stability and cash flow to support your life long term.